All right, let's talk about taxes in retirement. So when you go to retire, you still have to pay taxes. You're no longer will you be receiving an income from your employer. You'll be taking a distribution from your pension, your 401k, and possibly even Social Security as well. But you still have to pay taxes on that money. All right. So I'm going to share with you strategies on how you can minimize your taxes in retirement. Now, it doesn't matter if you're just starting to plan for your retirement or if you're getting set to retire. This is a very important topic. And the reason is, other than your rent or your mortgage, taxes most likely will be your single biggest liability. Many people don't know that. And I think we become numb to taxes in some way because with the digital checks, right? Who receives a paper check anymore? Very few people. So all you see is a direct deposit going into your account. That's it. Very few people actually look at their pay stub. If you were to look at the pay stub, it's a very large percentage in taxes that is taken out of your check. Now, when you go to retire, taxes doesn't go away. And this is where a lot of people are shocked when they go to retire. Like, wow, Mike, what is happening here? Yes, when we run the financial retirement snapshots, many people are shocked when they go to retire at how much they're having to pay in taxes. You know, the old traditional method suggested that we defer taxes till we retire in hopes that when we retire, our tax liability, our adjusted gross income will be less. Well, simply that is not the case. And most people are not paying off their home today, so they have their home, which is huge, and then they have their taxes. But anyways, let's go ahead and jump into this. I'm going to share with you some strategies on how to minimize your taxes, and it's something that you want to start taking action on today and putting into place. So let's go ahead and jump into this. All right, strategies to minimize taxes for retirement. Now, understanding taxes in retirement is huge, mostly because it's going to be your single biggest liability. But where does the income come from that is taxed? Well, your Social Security benefits. Now, the reason this is important, it doesn't matter if you live in South Dakota, Nevada, or Orange County, California. Your Social Security payment will be the same. There's no adjustment for that payment based on where you actually live, right? So how do you get the biggest bang for your buck? Well, this is where your location, and depending on where you live, you may want to consider moving to another location. We'll talk more about that later in the video here. But Social Security benefits, your pension, if you're a public employee or union and you receive a pension, that money is taxed. Your 401k. See, with your pension, your 401k, and your traditional IRA, that is money that is going into those accounts before tax dollars are taken out. So when you go to retire, the government wants their tax money. Same with Social Security. Now, and these are all taxed at different rates, so it's really important. Now, before we go much further, one of the things that I absolutely highly recommend, not only consult with your financial advisor, but your tax professional, all right? I'm not a tax guru. You have a tax preparer, a CPA. It is absolutely, you need to be working with them and share with them, hey, I'm getting set to retire. How can I minimize my tax liability when I go to retire based on what you have? And oftentimes your financial professional will work closely with your tax preparer or your CPA. We do that, all right? So always get advice and seek their guidance. All right, why are taxes a problem? Why are they going up? Well, I don't know if you kind of stay in tune with the news of what you see, what you hear, but this is the National Debt Clock. You can go to usdebtclock.org, and you can see here that our U.S. national debt is $31.7 trillion. That is absolutely huge. There is no hopes that we will ever pay that off in our lifetime. All right. So what will happen, what you can be guaranteed what will happen as the government continues to spend money for all these programs and the debt goes up, that taxes will have to go up. I mean, it's like a credit card, right? If you continue to spend on credit card and rack up a lot of debt on that credit card, you're going to have to pull in income somewhere, somehow, to pay for the debt, just to pay for the interest on that credit card. The interest payments that we are paying is absolutely huge. But take a look at this. All right. Debt per citizen, 94,000. Debt per taxpayer, 247,000. Now, that is absolutely huge. So anyways, I'm share this with you because if you hear that taxes are going to be lower, that simply is not going to happen. There's no way. The government has to raise taxes. So this is why this is an important topic, because you need to be thinking today on strategies on how you can minimize your taxes. So what are some options for you here? Okay, one option is a Roth IRA. Roth IRA, it's type of an individual retirement account and offers tax-free growth and tax-free withdrawals in retirement. All right, so the contributions, when you have a Roth IRA, you've already paid tax dollars on it in today's dollars, right? And so when you go to take it out, it's tax-free. So it's a great option, but there are some limitations with it. You can only contribute, here we are in 2023, you can only contribute $6,500 a year into a Roth IRA. If you're over 50, it's $7,500. Also, there are other limitations. Here's the earning limitations. If you're earning more than $153,000 as an individual or as a single, you simply don't qualify for a Roth IRA. If you're married filing jointly, if you earn more than $228,000, you don't qualify for a Roth IRA. So there are some limitations with that. So you need to work with your financial professional and also work with your accountant to determine what your adjusted gross income is and what you qualify for there. Another option to consider is an index universal life insurance called an IUL. And what it is it's a life insurance policy that is designed to accumulate cash and can be a great retirement supplement, especially if you're looking for a tax-free retirement solution. And let's say you're a high net worth individual or a business owner and your income is beyond the limitations of a Roth IRA, or you simply want to contribute more than the $6,500 that you can in a Roth IRA, right? You have the ability and the means, and you want to put more into it. This is a great option here to consider. Now, when you're looking at an IUL, one of the things that you absolutely want to consider is make sure you're working with somebody that is an expert on IULs. It is the most powerful and one of the most flexible, but at the same time, there are a lot of folks out there that simply don't understand them. They don't know how to structure them correctly, all right? Now, there's two buckets in an IUL. You have your cost of insurance, and you have to have insurance in it the way it's designed in order to comply with the IRS tax code 7702. It's what allows, when this is structured correctly, and allows you to take your income tax-free when you retire, all right? So that's another great option to consider is an IUL. So another option to consider is a health savings account, an HSA. HSA, it's a tax advantage savings account available to individuals with high deductible health insurance plans, all right? Contributions to an HSA, they're tax deductible, your earnings grow tax-free. And the withdrawals are tax-free if used for qualified medical expenses. Now, when you go to retire, you're most likely going to have some qualified medical expenses, okay? As we age, that's when health issues start to happen, all right? All right, municipal bonds. Municipal bonds, another good option to consider, are issued by the state and local government and are exempt from federal taxes. Now, you still may have, depending on the state that you're in, you still may have some state income taxes, but they're exempt from federal taxes. Now, they can be an excellent option for those in higher tax brackets. But it's also, again, I'm going to say this, it's important that you work with your tax professional on this. There's so many moving parts to this. Everyone has a different income. They live in a different state. There's different circumstances. And so the purpose of this is really just to share some ideas with you that will allow you to have a meaningful conversation with your professionals. All right. Now, qualified charitable distributions. Now, on a qualified charitable distribution, for those individuals over age 70.5, you can donate up to $100,000 per year from your IRA directly to a qualified charity. Now this reduces your taxable income. The donation is not taxed, and it can count towards the required minimum distributions. See, the RMDs, if you haven't heard that term, that is required minimum distribution. It means that whatever money that you have that you've accumulated tax deferred, when you reach certain age, that the government wants their money, they're going to require you to take a minimum distribution from that account, even if you don't need the money. And you have to take the RMDs, otherwise you're going to be penalized for it as well. The government wants their tax money. The only way they can tax that is when you take a distribution, so they have a required minimum distribution. So anyways, again, speak with your tax professional on that. What are some other options? Well, this is a great one. Move to a tax-friendly state. See, Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, Wyoming, the only states that don't have state income tax. Now, the state of Washington, it's important to note that for your high income and a high net worth, there's capital gains on certain high income earners, okay? But other than that, if you think about your state tax wherever you're at today, now I happen to be in California, and so state taxes are fairly high here. Just by simply moving, you can save some money on taxes. Now, one of the things that you also want to consider with that when you move to another state, and we've got another video that we're preparing for this, is you have to look at the property tax as well. There are certain states, for example, like Texas, where there's no state income tax, but the property tax rate is much higher than some of the other states. So you have to take that into consideration. This is why it's important to work with a professional. But anyways, I hope these tips help. And when you're thinking about taxes, it's important to start planning today to minimize your taxes, because it may take some time for you to put this into action and for it to really work for you, okay? That's why we talk about that you have to take 100% control of your retirement. Start planning today so you can retire happy tomorrow. I hope you found these tips on how to minimize your taxes in retirement valuable. Again, always make sure to work with your financial professional on that and your tax advisor for the advice specifically for you. Before you leave, make sure to hit that like and subscribe button. That way you're notified each time we come out with a great video like this. It's helping you take charge of your retirement so you can position yourself to retire happy. Have an awesome day. Take care.